because we do have the CAMS management with us. And that's the real question. I mean, what is the growth runway ahead for businesses which are linked to the whole theme of financialization of savings? That's what we will discuss with CAMS right now. October, as we all know, saw record equity inflows coming into mutual funds again, almost 42,000 crores being poured into equity funds. And SIPs, they've crossed the 25,000 crore rupee mark per month for the first time ever. So what does this mean in terms of business for a company like CAMS? Anuj Kumar, Managing Director at CAMS, is with us. Mr. Kumar, great to have you on. Thanks for joining in. And your numbers are really telling the story, right? Because first half, you have grown at 30%. And I think in terms of margins, you're clocking EBITDA margins, you're clocking 45 to 46%. So those are stupendous numbers. Can you quantify, because this financialization of savings seems to be almost irreversible. That's the universal view. So as we look at CAMS, not just at the end of FY25, but say FY26 as well, what is the revenue trajectory? What is the margin trajectory? Because while the MF business grows, you're also talking about growing your non-MF business. So what will be the revenue pie and the margin profile?
Hi, good morning, and thanks for having me over on the show. Broadly, I think we are living in very, very exciting times. The retailization of the mutual funds market, just financial awareness across population segments in the country, I think is driving a movement, and we're fortunate to be a part of that. Like you said, if you see last quarter, we saw a revenue growth of almost 32%, which was an across-the-board revenue growth. It wasn't driven by a single segment. MF grew about 32.9, but the non-MF part also grew very close to 32%. On a profit level, we expanded EBITDA year on year by about 40-odd%. Now, whatever has happened in the months of October and November, I would say is perhaps a bit of a correction in the overall scheme of things. But the solid base effect of what's happened in the last 8 quarters, almost 2 years, is standing us in good stead. So I think for the second half, while we're not expecting revenue to be in the early 30s, mid to late 20s. And when I say that, I mean 26, 27, 28% is entirely on the cards. Similarly, an EBITDA growth of 40%, which we experienced in the last quarter, I think maybe a little more muted, maybe in the mid 30s, which is a 34, 35% growth. EBITDA margin, which has crept up by about 1.5% a year, is in the range of 46, 47%. I think it's safe to presume that if things hold at this level, we will hold margins at 46, 47%.
So just clarifying, so you are saying that revenue for FY25 will probably be towards the high 20s. So that, in some sense, that's a revision, because earlier I think you were guiding for 20% growth. Now it's going to be closer to 30%, with margins holding at around 47%.
Yes. That's entirely possible if things hold at this level. And that is because, like I said, we have businesses firing on all cylinders across the board, not just in the MF book. So that looks entirely possible.
But EBITDA, the actual EBITDA growth, sir, that is, you're expecting that to come off a little bit.
Yes.
Between, you're saying 34 to 35%.
That's absolute EBITDA growth.
Absolute EBITDA, yes.
Yes. And a percentage EBITDA would be in the range of about 46% for the year.
Okay. This is largely going to be a function of, I mean, at the end of the day, the big overlay for you is how markets do, right? If we've had a couple of years of fantastic markets, flows have been very, very strong. So that is the big variable, right? I mean, as we head into 25 and look beyond FY25 itself. Absolutely.
I mean, just think of it this way, that as more and more retail investors kind of plug into the markets, businesses like KYC, KRA, and payments get a fillip. And as more and more, the overall assets increase, that's a fillip to our MF business. So that's how we participate in the markets, at a level of retail participation and at a level of net sales and AUM growth.
All right. Hi, Mr. Kumar. Good morning, and thanks a lot for joining in. This is Nigel on this side. Let's talk about a couple of important aspects. Now, flows continue despite the correction that we recently saw in the market. So your revenue base increases. But telescopic pricing, that comes into play, which could be a bit of a negative. Could you tell us, according to your analysis, which factor will outpace the other, in your opinion?
So think of the business this way, that the business is very efficient as it expands. It becomes efficient disproportionately as it expands. So as we get more revenue, I think our ability to take that marginal incremental revenue to the bottom line is very strong. That's how the business works. It far outweighs the telescopic pricing and any impact of the telescopic pricing. So we are always votaries of AUM expansion, whichever way it comes, whether it comes the retail way and we sell a lot and set up a lot of accounts, that's a good way. If it is market gains, again, it's a good way. But the telescopic pricing does not outweigh the impact of increased assets. And that's how the overall business works.
So just, Nigel, could you explain what is telescopic pricing for our viewers? What does it mean?
The way it works is that a buyer, as he buys more, buys incremental stuff cheaper. That's like any bulk purchase you have in any other product, whether it's IT or this, that when they buy more, the pricing goes down a little, and when they buy a little more. So as assets increase, their absolute pricing keeps coming down. That creates a very motivated buyer because the buyer has money left on the table on his P&L to spend on other things. As far as we are concerned, because we are efficient at the margin, it makes sense for us to sell a little cheaper as assets expand.
Got it. All right. So asset expansion will take care of this perceived negative. Got that. Mr. Kumar, also, yields have been stable over the last few quarters. What's the outlook ahead on a steady state basis in the long term? How should it look like?
Our guidance has always been that because of the pricing, yields will deplete a little. They'll deplete about 2% a year. It's also a fact that some of the passives outgrowing the actives, as in when it happens, will also bring in slight compression in yields. I think it is safe to expect that a 2.5% compression in yields on an annual basis will be experienced. But like I said, all our growth and profit growth trajectory is predicated on this compression. It is despite the compression that we will expand the margin.
So finally, tell us what, again, I go back to that question of the revenue mix, not at the end of FY25, but a year down the line. Let's talk FY26. What will CAMS look like? How much from MF? How much from the non-MF businesses? If you could just break it up. I mean, how much will insurance contribute? You're doing the AIF business. There is insurance. And also the margin and the break-even timelines, because in the past you've stated that the non-MF business should move towards 25% blended margin. Are you on track with that?
Absolutely. Absolutely. So if you see three metrics, one, non-MF absolute revenue growth in percentage terms should be faster than MF. I think we've accomplished that for many quarters. Secondly, in terms of margin, the non-MF portfolio is now in its teens, in its late teens, which means getting to about 25, 26% should be a 6 to 8 quarter journey, but nothing longer than that. I think a lot of the new plays will start breaking even and will start contributing. Within non-MF, KRA and payments are two shining jewels, which are anyways at very strong platform kind of margin trajectory. About 5 or 6 quarters from now, let's say end of FY26, we expect MF to be about 84 to 85%, non-MF to have expanded to about 15 to 16%. That's a trajectory that we believe can be delivered.
All right, Mr. Kumar, we leave it there. Good luck. Thank you very much for taking out the time and being with us this morning here on CNBC-TV18. That is Mr. Anuj Kumar, Managing Director at CAMS. That is, of course, one of the foremost capital market plays, which markets have liked over the years, and have stocks, of course, done very, very well.